welcome everybody to this video. And in this video, we are going to be talking on the topic understanding market behavior through price movement. But before that, I would like to briefly introduce the title of this course. The title of this course is simply Advanced Forex Trading with Price Action. That is the center idea was the core title of this course because I just feel there is a need for us to remind ourselves these things that form the foundation of every trading. This course is very, very important and certainly it may not be suitable for all new traders, right? Because this very course is more advanced. At the same time, I personally want to remind myself some of these things. That's why I decided to compile all these courses, the material. Then, on the process of compiling it, I'm reminding myself of so many things which I've learned, in the past. So this course is much more advanced compared to what I have done, previously. So the first topic we'll be talking on is this understanding market behavior through the price movement. So basically, all of us are familiar with price movement, be it in forex, be it in crypto, be it in stock market, or any other financial market assets that we have around the world. And at the same time, we also agree that we retail traders suffer a lot as long as trading is concerned. Seems to be that market, all the participants in the market, that the market is designed against the retail traders. Basically, I hope all of us know that forex market constitute many institutions like the central bank of whatever country that you are from, even the commercial banks. Those are entities, the hedge funds that trade currencies in large quantities, right? Which can then we have that hedge fund. Which other financial institution is the smart money and the rest, right? So this institution execute large volume of currencies. Is the example is a multinational global company can walk into any bank at the bank, right? And demand that they want to buy, let's say example, 30 million US dollars. You know that that kind of market execution is going to cause a lot of price movement, in the market compared to us individual traders that we just struggling with our $1 lot size, 0.10 lot size, and the rest. Those kind of volume cannot really move the market much compared to what these guys are doing. So all what we are fighting every day as a retail trader is just to decode to know the market when these guys are going to enter and also decode that tricks which they use to gain liquidity from retailers because that is one of the aspect. They trick us into the market either too early or late, right? So that we don't see when they come into the market to align with them clearly. So this course, I'll be trying to see how I can expose some of these things to give us that primary knowledge. Also remind myself, personally, because as long as you're a retail trader, there's no perfect retail trader. We're all striving to make sure at the end of the day or the trading week, we just make sure our trading account is on the increase. So at the end of the day, I'm sure we are going to learn one or two things to decode to know when these guys come into the market and how to use the market structure, simple supply and supply and demand, and then resistance and support to align with these guys. Also, how to analyze the market structure using the candle and key technical levels. So, by introduction, every movement in forex market tells a story, right? Be it in crypto or stock, a story of human decisions, emotions, and institutional intentions. Price is not random; it reflects the constant battle between buyers and sellers. So, the whole of the movement you see here, you can see, is just like a debate, right? Those that pull the most much volume are the ones that move, the market. So it's a two-way struggle always. That is why we don't see the financial market move direct, like I said in my previous course, straight like a railway track. You can't see this the financial market because before you see something will move straight like this, that means there's no opposition, right? But we have opposition in this market. That's why you cannot see price chart move straight. Is a fluctuation, and up and down movement involve buyers and sellers collectively. So by understanding how price behave on chart, a trader can interpret market psychology, then anticipate reaction and identify where strong moves are likely to begin or end, right? So in this topic introduces the foundation of market behavior through price movement, helping you see chart not just as line and candles, but as a visual language of demand and supply, and then a sentiment. So we are going to discover a lot of things, I'm very sure, in this course as we progress deeply, right? So first of all, let us understand the concept of market behavior first. We're still on the introduction. Market behavior refers to how price react to different conditions, such as economic release, institutional position, or liquidity imbalance, right? Liquidity imbalance. Should I explain that? Or what? Okay, let me talk about it. What imbalance simply means. Let me use this as an example. Let's say this is a price movement, right? This is the recent low in the market, and as you can see, I'm using a real-time chart on TradingView, right? So this is the price movement, recent low in the market, and price is coming down, obviously or probably to form a complete market structure. First impulse wave, a pullback, then the second impulse wave is about to happen once the price break out of this low. So the moment price break out of this low and move down to locate a possible support zone before it bounces to fill the gap, then there is imbalance created from this point to the recent low in this case of a downtrend, right? This is what I mean. Imbalance exists from this level to this level. There is imbalance, a gap, which other strategy choose to call it fair value gap, fair value gap, fair value gap, right? So until price return back to fill the imbalance, to fill this space left behind, there is imbalance in that place. So that is basically the meaning of that word that I just read in that place. So demonstrating it on a real-time chart, you can see this is it. So the price came down, broke the recent low at this point, right? Broke and returned downward, created imbalance, then returned back to fill the imbalance before the price continued downward. So that is what that statement simply means or talk about. So the forex market operates on the principle of auction dynamics. Price move up when demand exceeds supply and move down when supply outweighs demand. Please, you have to follow the notes very well because I took my time to outline this lecture material in a way that it can be reasonable to anyone that read it. So each candle you see represents a collective decision of participants during that period. So let's say I'm on a 1 hour time frame chart, currency pair USD Canadian dollar. What does 1 hour time frame simply mean? Simply means it took 1 hour for every each of these candles to form and complete. But of course, we have seen that these candles are not equal, right? It took this little doji candle right here, it took 1 hour to form. This strong bearish candle took 1 hour to form. Why are they not, the same? Price is reacting or form in favor of what affect the market in that particular time, right? So the events that happened when this 1 hour candle was forming maybe differ from what was taking place when this other 1 hour candle was formed, right? It may be that this is the presence of institution, maybe the hedge fund executing that order on display, and right here are the retail traders struggling with a low lot size at this point. So that is the difference and what you need to pay attention to closely. When traders understand this, they stop guessing and start interpreting the market logically. So the moment you have a clue of what is happening on this chart, you don't guess or use assumption to trade the market, right? Instead, you interpret and make a logical decision. Or what you'll be doing or try to do is to make sure you interpret the chart to align along with those institutions that influence the market. So on the number two, price movement as a reflection of market psychology. Price action mirrors crowd behavior. There are three key emotional forces behind most movement. I have to also remind ourselves, and for those that have learned my previous courses, know that I'm a price action trader. So you never come across a chart while I'm analyzing. So these are the forces, three key emotional forces behind most movement in the market. Fear drives selling pressure, especially when price drop sharply. Then we have greed, fueled by momentum when traders chase moves late. Uncertainty, great range bound market as both sides hesitate, right? These are the key forces, key emotional forces that drive the market all the time. Fear, greed, uncertainty. And almost each and every one of us as a retail trader have encountered this during our trading journey, if not till date. Even after many years, majority can still suffer victim of most of these things. Fear. You can see a perfect entry to go into the market now. You see confirmation, but the fear of if your decision is going to be right cause you to miss that entry. Why are you afraid if you really know exactly what you're doing? You can see. So the moment you're still exhibiting some of these things simply means you're just guessing the market. You don't really align with it properly. Because if you know what is happening or what is about to take place in the market, I don't think you'll be scared to enter a trade after you see a selling, confirmation, right? Then in the case of greed, this is really applicable to lot size, right? Some people does not respect risk management out of greed because they want to make it in the market overnight. A trade that you're supposed to approach depend on your equity or trading balance. Trade you're supposed to approach with 0.20 lot size maximum, but out of greed and the urge to make fast money, you now went and opened the trade with one lot size, and this end up liquidating your accounts before time. Your broker give you a margin call. Then uncertainty. This one great range bound. So all these are reflection of what we see on this chart. This is simply range bound. Price is just moving sideways without any specific movement. This simply means uncertainty. The institution involved in the market, this is definitely, like I said before I even got to this point, I made mention that this movement is likely retail traders movement, right? So uncertainty without knowing what is going to happen next can cause a movement like this, right? So pay attention. We are going to somewhere, certainly. Institutions explore this emotion by building positions when real estate traders are most emotional. Recognizing this stage helps you avoid emotional trading and align with the dominant flow. So these guys capitalize on our mistakes a lot. You might have read or came across things that is say forex market generate over, is it 1 to 2 trillion every blessed every trading day. Where do you think the money come from? Like the profit that is secure is from us retail traders. They capitalize on our flaws, to generate the profits and the revenue that they need, right? So the third thing is phases of market movement. Please, we are heading to somewhere, just pay attention and follow properly. Number three, where is it? Where is it? Market phases, right? So there are basically three phases in this market chart. This is applicable to even a crypto chart. So we have the accumulation phase. Institution quietly buy or sell orders. Price moves sideways in a range, right? What is accumulation? Price accumulation is simply, can I illustrate that? Okay, so can you use, let's take this typical example. Institution drove the price down, right? This was a very strong, sharp sell day. Then all of a sudden, you start seeing price going sideways. This everything is illustration. Let's try and follow. You start seeing price going sideways, and this usually occur on a downtrend. You have to take note. This is accumulation. Then you see price accumulate or consolidation. Then the next thing is going to break out on the upside, very sharp, right? So this happen in a support zone or demand level occasionally, right? So this is accumulation. Then we have expansion. Once enough orders are collected, price broke out strongly, showing clear direction. That's self-explanatory. So after these guys might have confirmed, collect a lot of orders at this point, and uncertainty of retail traders, people jump into the market. Then you see they now release the trade out of the box, right? Out of the consolidating zone to show a clear direction. So how do we approach situation like this? Also, I have a course which will talk on this, pattern. Let's say the price broke down on the downside. This consolidating zone, I'll put it in a box, which the price form a range bound. So expansion is after the price breakout. So how do we know when the price is going to break out so that we can align with the institution that influence the market? Volume, right? The volume and candle pattern that form, right? We are going to get to this point, but for now, but because without knowing when these guys are going to release this trade to break out of this consolidating zone, that means they are going to jump into the market late. I'll show you guys how to trade this in this very course. Though I have course on chart pattern, which I use market candle patterns that form in market to illustrate how to step into this kind of market or how to approach this kind of trade. I'll show you guys much later in this course. But one idea that you need to decode when the price will break out of this is through volume. And at the same time, the next thing is once the price is still in a consolidating zone, right? The, the direction that the market makers decide to throw a stop loss hunting, something like this situation price seems like it's breaking out of the consolidating zone. The next thing, pull back and say close within. Just know that the original breakout is going to open in the opposite direction, and very soon you see in this case, after the stop loss hunting, price broke out on the other end. That is another signal to get, but there are so many of them. And how you can trade this, even the price broker, you miss it. What are you going to do when the price return back to fill the imbalance? Retail traders, if you know what they're doing, can come and wait at this point. As the price return to fill the imbalance, you execute the trade with the market makers and return the price movement in the prevailing trend, right? Then we have distribution phase. Large numbers, large players close or reverse position causing swing momentum. So this is similar, distribution is similar to accumulation, but this time around it usually takes place in an uptrend, right? Distribution takes place in an uptrend. The moment you see price coming up, in this case, they started ranging. You have to wait for a breakout, which likely breakout in the opposite direction, taking the price downward. This is simply a change of direction. So at this point, institutions are collecting orders, right? I believe we all know what is called pending order. That's why I say this course might not be suitable for an average new trader, but I'm trying to break it down to the point everybody can understand, but I will not be able to touch some few things because I don't want the course to be too long. So what was I saying? So this is a collection of order which made me to mention pending order. So this is simply a collection of orders. So after institution might have finished collecting that order, the breakouts of this ranging zone, while retail traders are uncertain, guessing what is going to happen next in the market, if the price is going to break out on the upside or a downside. Institution already know what they want to do. They already design and plan the order and keep while we retail traders are guessing. So the all the struggle is just to make sure we can interpret these things and know when and how to align with these guys. You see, at this point, the breakout took place of the consolidating zone. Look at the candles. This is large volume of candle. About 4 selling candle lead to the breakout in this consolidating zone, and that is enough example. After seeing this is visible enough to know that price is going to break out because candle that were forming in the consolidating zone lack the volume, it lacked the momentum, didn't show a clear direction of who is controlling the market at that point. Then number 4 is building coming. I'm looking for my sidebar, okay? Then number 4 is building block of price behaviors. Price move in waves consisting of impulse move, impulse move in this case. Okay. I like to use real-time chart to illustrate this, so everybody can get along. Impulse move. So this movement to this level is impulse, right? This is impulse move, or you can call it impulse wave. This is a pullback, then the second impulse wave. Those that trade the smart money concept is going to be very familiar with this. So that is what basically impulse. Corrective move. This is a correction or a pullback, or you call it a correction. So you can, let me label it impulse wave. I will indicate with I, right? From this resistance level to this level is what is called first impulse wave, right? And we still have next impulse wave. I'll label it second. From this pullback, this level where the price return to fill the breakout region to this support is the second impulse wave. Then you can call this from year to year pullback or correction. In this case, pullback. In this case, or you call it bearish correction. In this case, bearish correction. That leads to me reminding you that it is not all breakout that you see in the case of a trend line that is actually a reversal. Some are, correction. So this is a bearish correction in this case, or you can call it a pullback. Then we have the fifth point, analyzing candle behavior for market group. Candle and micro expression of market psychology. I'm putting this divination for the sake of new traders in our midst. Long bullish candle indicates strong buying aggression, right? In this case, that I show this is strong selling candle in this case. It shows the sellers are fully in charge of the market. Look at the sell that took place in the pullback, the sell continuation. This is an indication that sellers are actively in charge of the market and they gather enough momentum to cause the movement or the price movement that we just saw, right? So long bullish candle indicates strong buying progression. Long bearish candle shows strong selling control, just as I illustrated. Small body candle or doji show indecision or low participation. Why I decide to call this retail traders action? Because retail traders execute trade every time except when the market is closed during the weekend, right? So why do I have the is to call this retail trader move? Just like I put this doji simply means indecision or low participation, meaning what I mean is that institutions that execute large volume of orders are not present at this point, right? Basically, the candle that form at this point is doji, which simply means in a real situation, doji means indecision. You can see majority of these candles, are doji. Indecisions, neither buyer or seller are actively in charge of the market, so price just form a range market within a specific region. You can choose to call it a range band. So observe how candles form near key levels. Take notes such as high, lows, or zone of interest. Reveal whether the market is preparing to reverse or continue. Example: a strong bullish candle after a period of indecision near support often signal that buyers are taking control, right? Just in this case. After this consolidating movement, you can see the candle that took place next. Same thing applicable to this, right? After this short-term lack of buyer's momentum at this point, you can see the sell candle that line up next. This shows the momentum that sellers are in charge. So the next thing you need to do is to use your strategy, go to your time frame, and look for a perfect entry to enter in the market. So how institutional traders influence price behavior? Unlike retail traders, institutional traders, bank, hedge funds, and large market makers move massive volume that shape price action. They often build positions slowly to avoid revealing intent. Because if we know when they are coming into the market to execute trade and the direction is going to be, we will not have the loss that we usually retail traders usually incur to the level that it is estimated that 90% of retail traders are not making profits in the market. This is high. So I believe the record says a little bit above 96. Yes, that is because market makers doesn't allow us to know the intention, what they're going to do next in the market. If we know the intention, then nobody will certainly be losing trade to the level that it is a peg at this level, 90% or 90 plus. Retail traders doesn't make consistent profits in trading. So our intention this course is going to review some of these things, though we can't do it all, you can't get it right. But this course is going to blend you to the level that even if you're the type of trader that execute one trade in a week, you take time, plan your trade, execute it properly, secure the profit that will satisfy you for a certain number of days, right? So they manipulate liquidity to trigger stop loss and create entry opportunities. In this case, stop loss, liquidity sweep, is it the one that trigger the market at this point because they know that this is support zone, right? And what is the intention of support? Once price move into the support zone, it is assumed that buyers are taking over. I mean, buyers are stepping in and will move the market upward. That is what the support means do. You need to wait for a confirmation because support can be broken, right? Support can be broken in just a matter of time. So having noted that this is support, retail traders majority is going to jump into the trade, start buying, taking buy into the support without waiting for a confirmation. So if retail traders go into the trade at this point, our stop loss because we don't have much liquidity or equity that we need to stay float in the market. What do I mean by float? Allowing a drawdown to the level the market is going to finish and return to the other direction. We don't have it. So when we execute the trade, we stay, our stop loss is usually a little bit below the zone. And this happen. Market makers, institution through this liquidity sweep down. Do you know the number of stop loss that I've cleared in these points? Like in this case, number of stop loss and the money that I've collected at this point because of this stop loss funds that you just see here. So that's why it is always advisable to wait for confirmation. In my own case, I wait for confirmation breakout, then price retest before I take my entry. We're going to get there gradually. Return to key price zone to fill unexecuted orders. Return to key price zone. Returning to key price zone to trigger unexecuted orders simply means to fill the imbalance that was left behind, just as I stated earlier. This was a sell. Price broke, market broke the structure, market structure at this point. Came down, create imbalance. At this point, this is where retail traders, mostly the smart money concept traders, usually you have missed all this entry because maybe you didn't know what is going to happen next. Since we can't, it is difficult to interpret the intention of the market makers. You miss this movement. So anyhow, you should return when institutions return to execute the orders that they left behind. Let's assume a particular commercial bank want to sell 30 million worth of 30 million US dollar worth of USD at this point. So this movement from this point to this point might have incurred 20 million, leaving $10 million behind. So coming back at this point to execute the leftover 20 million is what brought this second phase or second impulse wave. And at this point, this is where retail traders usually join force with institutions to move the market depending on the direction, right? So you already missed this movement. Come and wait at the retest or when price come back to fill the imbalance, then you join forces with them to execute the remaining orders that was left behind. So that's basically how to approach the market gradually along with the institution. So understanding this institutional behavior through price structure will help traders identify real movement instead of reacting to traps or fake breakouts. Actually, I suffered this a lot at my early stage. Suffered this a lot because of what usually causes. Sometimes you know all these things going to happen. Sometimes you know there's no confirmation yet, but impatience and the pressure to go into the market will just force you to execute the order before time. So in summary, market behavior is a direct reflection of human and institutional psychology displayed through price movement. Every phase, accumulation, expansion, and distribution represent an ongoing balance between demand and supply. Price moving wave of impulse, etc., and corrections, which is also known as pullback, revealing shifts in control. Candlestick behavior provide micro insight, that is a candlestick pattern, the volume, provide micro insight into who dominate the market at any given time. Mastering price behavior help you anticipate moves instead of chasing them. The first true step to advance price action trading. So that is it. So if you pay attention and follow this course, I believe your trading journey are not going to be the same. It's going to take a shape because the way I use my own way of instructing or teaching, I take time to show everything how it is done on TradingView. I'm not going to go into the too much video editing that will seem like a movie, right? I'm going to break down this one after the other. Once I pick a point, we move. You can see how I'm displaying my screen, right? Once I pick a point in the lecture note, we move to real-time chart or TradingView to carry out an illustration. So we are going to do a lot in this course. Stay tuned and follow up. Thank you. See you in the next video.